Well, we know we need to use stop losses. Now, let's talk about the different ways you can kind of set them up, the different types, and there might be a certain type that maybe calls to you or say, oh, that makes sense to me. That's how I want to use my stop loss order. So there's different approaches to how to execute it. And they're all really related as far as, again, trying to minimize losses and maybe even maximize profits would be the alternate way of looking at that. And so they're related. So you could be using setting your stop losses based off indicators about the money you have invested for a particular trade, or the timing. You might want to set a time frame as far as when the stop loss gets executed. And the thing is, though, they're related. They don't always match up, right? They all serve their own individual purposes. And so you want to choose an approach that works for you. And if you find one approach isn't working or it's not working as well as you want it to, just adjust it, within that, type of stop loss. Just adjust maybe, how, let's say if you're looking at time, maybe you're adjusting your time periods longer or shorter, for example, or try one of the other approaches that we're going to learn about here. So you can always make adjustments to it, but you'll want to start thinking about it and start picking about one type of stop loss that seems interesting to you. They're all very valid, they all are used, and they're all, very good in their own ways. So let's take a look at these. A famous stop loss rule is the 2% stop loss rule, and it was popularized in the book The Way of the Turtle by Curtis Faith. Looked at taking amateurs and teaching them how to trade and using some rules around that. So if you're interested in that, Way of the Turtle is a very interesting book. And the idea of the 2% rule is you set a stop loss, or you stop a loss when it reaches 2% of your starting equity. Think of your equity as your money. What do you have totally available to trade, right? So it could also be termed like your trading equity or your investment capital. Basically, it's the amount of money in total that you've set aside for trading into a whole bunch of different trades. So for example, let's say you have 10,000 units. It could be dollars, rupees, whatever your currency is. You have 10,000 starting equity. So 2% of that would be 200. So that's saying under the 2% stop loss rule, you can afford to lose and would set your stop loss at 200 on each trade, right? So it's a 2% rule around that as far as your total equity. Now you might say to yourself, well, 200 out of 10,000 doesn't sound like much. Well, that also depends on how frequently you're trading, right? So it doesn't sound like much, but if you're trading many securities over short time frames, it can really add up fast, right? I mean, so it's a real fast way that you can really kind of go through your equity if you don't, put in some stop losses around it. And so that's where this 2% stop loss rule came from, the book The Way of the Turtle. And you can probably see that this is a money stop, right? So I'm using my stop based not on an indicator or anything. I'm just using like, hey, if I make a trade, I'm willing to lose 200. That's it. After that, I'm out no matter what. Another type of money stop is what's called a risk-reward ratio. And it's really the relationship of your expected gain versus your expected loss. So the higher the risk-reward ratio, the more desirable the trade is, right? So that's the idea about that. And then you can use your stop losses around how risky, let's say, a particular risk-reward ratio might be. So let's look at this as an example. So for example, let's say you have a security that's at 50, right? So you have a security that's at 50, and the indicators say the potential gain is to a price of 75, right? You're looking at your indicators, you're looking at where it might go. Indicators are saying, okay, or you feel you might make 75, or get to the price will get to 75, so you'd make 25, right? So you'd make 25. So you'd set your stop at a percentage below that initial price. So let's say you're willing to lose 20%, right? So you're willing to lose 20% on each individual security trade, which would be, in this case, so you're not looking at overall equity, you're looking at individual trade, which may be all different amounts. So in this one, it'd be, I'm willing to lose $10 or 10 units, right? So I'm looking at that, buying a security at 50, 20% of 50 is 10, right? So that's where I'm setting my stop below that. So if I'm buying at 50, my stop loss would be set at 40, right? 50 minus 10, the amount I'm willing to lose. It's a percentage of the initial price. In essence, I'm willing to lose 10 in order to make 25, right? You see that, how I'm thinking I'm going to get up to 25. My indicators are showing that. Maybe there's a trading range that's kind of established that might show that, and I'm at the bottom of the range or near the bottom. And I'm saying, okay, I'm willing to invest 10 to lose 25. So the ratio in a risk-reward ratio is thus for a $25 or 25 unit reward for $10 at risk, or 2.5 to 1. right? So if it was at, let's say, $40 in reward to $10 in risk, that would be 4-to-1, right? All right, so now you actually, now if you look closely, you might be saying, wait, that's actually backwards. It should be called the reward risk ratio, right? Because the first number is your reward number. I think because terms of risk reward is used in many areas outside of trading as well. That's why they use risk reward. But technically, you're correct. It should really be called the risk reward risk ratio. Nobody calls it that. They all call it the risk reward. So with this type of ratio, you want to be conservative a little bit in using this type of ratio and emphasize the downside risk more, right? If anything, you might want to say, okay, I'm not as willing to lose as much, especially getting started with it. So you might want to make those numbers a little bit, play around with them. There's different things. You could go higher, you could go lower than 20%. That's a big drop. Maybe 5% would be the right number. Those are all okay. Or you kind of use it the way of the turtle a little bit. You're looking at 2% equity. And the thing you can see from this, it can be a little complex to calculate, right? So you have to kind of factor that in. But if my risk to reward ratio, or reward to risk, is a higher number, that means I've got higher potential gain. So maybe I'm willing to take a little bigger loss because the rewards are much higher, or maybe I'm willing to invest a little bit more money because the rewards are higher too in comparison to the risk. So this is a way you're setting in the stop. You're still buying with the whole idea you want to hit that target profit, and you still want to, every trade to be profitable, of course. This is just a way to minimize downside risk, and how much you want to have for that downside risk, you set as far as a percentage they'll fall below that initial buying price. Maximum adverse excursion, or MAE, is a timing stop. You think about timing. And a lot of times trading software will just kind of show you a graphic like the one we have below, where it kind of shows you where these MAEs are. And basically, it's what it is, it's a worst case loss that can occur over a trade's time frame. That's why it's a timing stop. So the software or the platform will do the calculation, but the idea is you're calculating the biggest change in the high-low range over a fixed period. Let's say like 20 days. It could be 20 minutes if you're a day trader, whatever your time frame is. That matches, the idea is you want it to be a fixed period that matches your typical holding period. So you get results back from, this is where back testing can really help on your trading platform to try these different time frames and see how that would work for you, and using the provided indicators of this MAE. And you use a percentage or fixed amount to set the stop loss around that when you're playing around with the platform again. And the opposite of that, by the way, is a maximum favorable excursion, or MFE, which you can actually use for profit-taking targets, right? So when you'll see a graphic, let's say on the platform, you'll see a graph like this where it's going to kind of show these ranges, and you can see that the lowest of this time frame, whatever that time frame is, that's your total time frame you're seeing as an image. The lowest low of that's your MAE, and the highest high would be the MFE. And so if you look at that lowest low, you could use a percentage of loss, like we were talking about, like these other ones, 2%, 20%, whatever it is, or a fixed amount, whether it was $200 or 200 units, whatever. And you can set it based around that, and you'd look at that kind of that center line. You'd look at when you're buying, and then you would set based on this kind of indicator or this tool that your trading platform will provide you with it. So if you're interested in that type of timing thing, look under your trading platform for more details on how and the main thing is you want to establish the range you want to look at and have the range match up. If your range doesn't match up, then you might be a little bit too aggressive or not aggressive enough, depending on your time frames. So you want to look at that as far as the time frames that you've been trading on and that you're comfortable with. Another type of money stop that's really, really popular and really used, a lot more, I think, than even MAE, is trailing stops. And this is a great idea. I mean, the idea is that you raise the stop loss price as you make profits, right? So you have your initial stop loss when you first buy because you always are going to set a stop loss. But then as it starts to rise, it's working out, your analysis has worked, and the price is rising, and the trend is established, and it's going up, you're going to start a stop loss along the way. So basically what you're doing is you can do it on a percentage basis or a fixed amount, percent or a dollar or rupee or whatever type of currency amount. How frequently you're updated, that's up to you. It could be daily, it could be more frequently, it could be less frequently. But the idea is that you're updating your stop loss to capture some profit. And let's say you want to set it as a percentage. Like maybe you say, well, I want to keep raising my stop loss to cover 80% of the previous day's gain, right? So it's going up, and now each day that it goes up and you're in a nice upward trend, maybe I'm adjusting my stop loss upward, so I'm always capturing at least 80% of the previous day. And if it goes like that over several days, you can see how I'm really capturing a lot of profit all along the way while still giving me the safety net of a stop loss. But I don't have my stop loss all the way to the bottom when my initial thing, waiting for it to go all the way back down. I want to capture some of that profit. And that's where a trailing stop helps you. The key is to keep the stops updated to protect those gains and guard against losses at the same time. So that's why it's nice. It's kind of works in concert with targets as well. So the benefit of all that is it's highly protective, right? You're not waiting for it to go all the way up and all the way down. You're going along with it as it goes up, so it's highly protective and you're locking in those gains. The downside is there's some frequent updating might take time. It depends on how often you're trading, how many securities you're trading. If you're trading in lots of securities and you have many of them in play all at the same time, it takes time to check them and update them. And also some random noise activity can activate your stop and get you out before you want. So if you're capturing, let's say 80% of the previous day's gain, that's pretty good because that would be a 20% downward move. You've already locked in a lot of gain, but maybe you want to make that a little bit less of that. But let's say I'm setting my stop limits at, let's say 2%, a 2% drop. Well, 2% or 98% of the gain. Well, then I'm looking at maybe where it might drop 2.5%, 3%, and my stop loss is activated, as in I sell the security automatically and locking in those gains, which is a good thing. But then the downside of that is, maybe that wasn't really an event, and maybe I missed out because now it went back up as far as the profit. So you can adjust that as far as covering those, putting those trailing stops in, and then just adjusting it either on a percentage basis or a fixed amount. The last 3-day rule is an indicator-based stop, right? So we're going to use our tools here. So it's very basic, but it really works. I mean, it follows along the lines of your indicators and market sentiment as well. And so the idea that if your analysis works, right, you've done all this hard work to identify a trend, you should start seeing some profit right away, right? It might go down a little bit, things move a little bit, but the idea is you're identifying a great opportunity to buy in as far as on this trend. And if you're wrong, let's say it's not the great time, or it just doesn't work out, then you have time to get out quickly too. So you could set something like a round indicator that's also around a little bit timing too. Is you could say something like you would exit if the price passes the lowest low of the last 3 days, right? So an uptrend would be a series of higher highs and higher lows. And if that doesn't seem to be happening and it really starts to kind of turn the other way, you can get out real quick in a 3-day rule or whatever your time period is, but typically it's a 3-day rule, that if it passes the lowest low of the last 3 days, that's the time to get out. Not just because it went down a little bit, but it's past the lowest low of the 3 days, and that's constantly kind of moving forward along that. So you're looking at your indicators as far as highs and lows, and you're using 3 days, so it's a little bit of a combination with a timing indicator as well. Another indicator, another stop that's out there, as far as the last one really kind of look at here, is a pattern stop. And this is an indicator-based stop. And this is where you're trading off of your indicators. You're trading off indicator patterns. So some patterns will tell you where to put your stops, right? You're approaching either a support or resistance line, and you're looking for that, and you're seeing if it's breaking through. Let's say like a support line as an example, and it's going to keep going downward, not bouncing off that support line and go back up. So it's like using, and you can use it for profit targets. We talked a little bit about that too, but it's really just the opposite. So you'd really be looking at, like where you have a channel of some sort at those support lines. If you bought something and you're going to set a stop loss maybe at or maybe a little bit below the support line. That way, if at some point, if something happens that breaks through the support line, you're selling, then locking in some profits. Or you could do it, where you get more up towards a resistance line, and maybe halfway through you just want to get out because you want to approach. You think it's hit the support line too many times. Maybe you want to put it in more towards the middle and get out a little bit sooner. So this is this is an idea where you're using your indicator to kind of tell you where to put your stop loss and really buying your, and making your trading decisions. So let's say in the example, let's say you look in the far left there, let's say you buy near a support level and you're anticipating a price rise. Let's say we're at the far left of this example chart here. And you would put a stop loss below the support price. You bought at support, maybe a little bit higher than that, and at the support level. So you put your stop loss below the support price line in case there's a downward trend, all of a sudden breaks through that level. Something happens, there's a big event, something unexpected, and it breaks through that level. So there you've protected yourself against those losses. And then as it rises up, then maybe you want to, sell as it approaches the resistance level, and then repeat it over and over again. But you can see this one, this is an example where it goes up to a nice resistance level, but then comes down, but doesn't get all the way to the support level at first. It does after a second trend or a second rise up, kind of where that middle arrow is. And so you're kind of watching that as far as maybe I would raise up my stop loss and make it more of a limit where I might go a little bit higher above the support level, or maybe I go a little higher than that even to lock in profits. So you have to kind of look at that as far as how you want to do it. But the idea is that you're using an indicator of some sort that's going to tell you that when this indicator condition happens, that's a sell signal, and I'm going to sell on that. And you need to kind of watch for that as far as when you establish your trades. But you're already kind of have that in there, and you've set a stop loss based on that indicator at the time of buying. That's the key. Again, you're always doing it at the time of buying to minimize those losses and hopefully maximize those profits. So stop losses, very, very important. Do it. It's going to really help you become a more successful trader for sure. Because really where people get in trouble with trading is they don't have stop losses. All of a sudden something happens and it drops real dramatically in price, 10% down, 15% down in a very short period of time, within minutes or hours sometimes. And all of a sudden, boy, now you've set yourself up for a losing proposition. And that's where if a stop loss on place, where a lot of traders will be like in denial, like, oh gosh, you went down so far, 15%, it's got to come up some. And maybe it does, maybe it doesn't, maybe it trades sideways for quite a time. Either way, you're more like locking in losses at that point. As opposed to profits, you're locking in a loss. So having a stop loss, kind of takes you out of those trades that maybe just don't work out. So when you have your great trades that are going to hit these target prices and really have these nice profit runs, you're going to do great with those and minimize losses on the ones that maybe don't work out as perfectly as you would have hoped.